The US dollar's fate hangs in the balance as the world awaits tonight's highly anticipated jobs report. But here's where it gets intriguing. Historically, August jobs data has a reputation for falling short of expectations, with 12 out of the past 18 reports missing the mark. So, will this month's figures defy the odds or reinforce the trend? The answer could significantly impact the Federal Reserve's upcoming decision on interest rates. Despite recent labor market weaknesses fueling rate cut expectations, the Fed remains cautious, leaving markets on edge. Analysts attribute the August anomaly to summer holidays and low survey response rates, often leading to upward revisions later. This time, markets anticipate 75,000 new jobs, with the unemployment rate creeping up from 4.2% to 4.3%. And this is the part most people miss. The Fed's decision hinges not only on tonight's numbers, but also on the broader economic landscape, including global trade tensions and domestic spending patterns. Speaking of spending, Australians are on a shopping spree, thanks to rising incomes and household wealth. Reserve Bank Governor Michelle Bullock warns that this increased consumer activity might stall interest rate cuts, a stark contrast to the rate reduction expectations fueled by strong second-quarter growth. Here's a thought-provoking question. Is the Australian economy overheating, or is this spending boom a sustainable driver of growth? On the global stage, Bullock acknowledges that the worst-case trade war scenarios haven't materialized, yet she highlights tariffs as a lingering source of uncertainty. Meanwhile, the Australian dollar remains trapped in a 4-month trading range against the US dollar, with key support and resistance levels at 0.6400 to 0.6600. Across the Tasman, the New Zealand dollar is under pressure as Federal Reserve officials send mixed signals about rate cuts. Governor Christopher Waller advocates for immediate reductions, while Atlanta Fed President Raphael Bostic urges caution, suggesting one cut might suffice for the year. St. Louis Fed President Alberto Musalem strikes a neutral chord, acknowledging current rates, alignment with economic conditions, but flagging job market risks and anticipating tariff-driven inflation to ease within 2 to 3 quarters. But here's the real question. With such divided opinions, what's the true path forward for interest rates, and how will it impact the Kiwi? As we navigate this complex web of economic indicators and expert opinions, one thing's clear. Tonight's jobs report is just the tip of the iceberg. So what's your take? Do you think the Fed will cut rates, or will they hold off? And how do you see global trade tensions shaping the economic landscape? Let's spark a conversation in the comments.